Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. We continue to monitor this story about the U.S. economic outperformance relative to the rest of the world this week, despite having very little to show for it in terms of US economic data. But that does not mean that we are not seeing the markets respond. It likewise does not mean that we don't have indicators to watch. And today, we are going to focus a little bit afield and discuss the monetary policy announcement that's coming up here over the next 24 hours, coming from the Bank of Canada. And the question, of course, might very well be, well, why do we need to care about what happens coming up from the Bank of Canada? Isn't it the case that Canada is so thoroughly tied at the hip with the US economy, is so thoroughly dependent on US demand that it isn't what you might want to look at as opposed to the other way around? If the US economy is strong, as we seem to be finding out more and more with every successive economic data release over the past several weeks that tops expectations, be it the ISM data, be it the retail sales report, the inflation report, the jobs report, on and on and on and on and on. Uh, if that's doing well, should we not then presume, well, if US demand is strong, then Canada will be okay and move it right along? Well, not quite. Uh, and indeed, the situation in Canada seems to suggest something very, very interesting about where the US economy and US markets may be going. And as we look at the way that a particular market responds to what the Bank of Canada says here in the next 24 hours, we might get a good sense of where we are going next. And that's where things get interesting and why we are going to focus on this today. So let's initially consider we are looking for a big rate cut from the Bank of Canada. We have rates currently at 4.25%, and the expectation is that we are going to end up south of 3.5% by the end of the year. So call it then three cuts. If you measure a single cut, as the Bank of Canada does, a single standard size cut as 25 basis points, from 425 to 3.5 would be 75 basis points, and we're slightly short of 3.5 here. It's tempting to put such a small difference down to a rounding error rather than a slight possibility that maybe we'll have jumbo-sized cuts at the two remaining meetings for the year, the one this week, indeed tomorrow, or the one in December, and that instead we're going to get three cuts, 50 basis points this time, 25 basis points in December. Needless to say, that's a very aggressive easing outlook. Much more aggressive than the Fed, which, of course, has just cut by 50 basis points, but that was its first move. As we can see from the chart here, the Bank of Canada has been cutting. Rates have been coming down for some months. It is ahead of the Fed in the rate cut cycle and now seems to be stepping on the gas. So why is that? Well, the inflation side of this story begins to explain. Inflation has dipped below 2% at the most recent headline reading. The target for Canada is 1 to 3% for inflation, and so that makes a 2% level the midpoint, and we are now below that. So the pace of decline seemingly accelerating, and in fact, 1.6 which is where this landed, was a bit lower than the expected 1.8%. So inflation in Canada is aggressively decelerating. But of course, what that underpins is how it is that you get inflation that comes down so quickly. And that is economic malaise. That this is the composite PMI index for Canada. This is September's report. And what we see here is that for 4 consecutive months now, overall output has been shrinking. Economic activity has been shrinking. You can see that here, as ever, the 50 level is the boom bust level for the PMIs. And we are now below that level for 4 months. Not only that, we're actually going still lower, which implies that not only is the economy contracting, it is contracting at an accelerating rate. That would, of course, explain how inflation is falling and why the central bank might want to move aggressively in the direction of rate cuts. So then why is the U.S. robustness that we've seen not helping? After all, close to 80% of Canadian exports go to the U.S. And indeed, we can see the stark contrast between what's going on in the U.S. and what's going on in Canada. Here, the composite index at 54.4 is idling, having hit a 12-month high back in May. So this right here is May of this year. This back here, of course, May of 2023. So in May, overall economic activity growth, subsuming both services and manufacturing, hit that 12-month high, and for the next 4 months has basically idled, which is to say the U.S. economy is growing at a brisk rate. It isn't accelerating, but the rate at which it's growing, it is quite healthy. It is, in fact, the cycle high post-COVID. Here's the sort of deceleration after the catch-up jump following the pandemic. We get a little bit of an overcorrection on the downside here. As of the beginning of 2023, we established what is the new normal right here, and we are at the top end of that range. So the U.S. economy is doing robustly well, especially compared with Canada. Why is this demand not showing up? Well, when you look at the breakdown in manufacturing relative to services, you start to get a sense of what's going on here. Notice the manufacturing index is doing a little bit better recently. It's not exactly doing great. It's still sub 50, but it is much closer to standstill than is services, which is deteriorating quickly and explaining quite a bit about what's going on for the overall index here. This is services with manufacturing, and this pulls them apart. As you can see, services looks much more like the overall because, of course, services is also 70% of Canada's economy. So a weak service sector is the story here. Now, why is it that we have this weakness in the service sector? Well, it depends mainly on domestic demand, not demand from external markets. We did have a bit of a pickup in manufacturing, of course. Here, we can see that coming out of the pandemic, manufacturing was growing much faster than services. And if we know, of course, that 80% of Canadian exports are headed for U.S. markets, that gives us a sense that goods demand was very strong here as relative to services. Well, looking at U.S. PCE data, we can see where that is. So here is core goods as a contribution to overall price levels. Here is services. Now we can see that coming out of the pandemic, 2020 into 2021, there is a lot more upward prices pressure from the goods sector than anything we're seeing now. And that's that COVID era binge on goods. Nobody's going anywhere. Nobody's participating in things like concerts and flights and vacations and whatnot. And of course, that sees a shift in spending patterns toward buying things that can arrive in a cardboard box at one's doorstep. So that there is a swelling of goods buying. You can see significantly so as relative to what we had before the pandemic. That demand, of course, ends up bidding up prices, which is what you see here. So you can actually see that upswell. Not surprisingly, then, in that context, right around the same time, you get an upswell in Canadian manufacturing, which benefits and outperforms services by a good margin when this occurs. But of course, what we've seen since is goods inflation has been all but fully squeezed out. That tells you a story about where goods demand is relative to services. And that leaves Canada in a lurch because the manufacturing side has basically settled into digesting what was an overshoot and is basically hovering in a range, whereas services, the much bigger part of the economy, is dependent on domestic spending, which is flailing. Why is that? Well, consider first what's going on with Canadian households. They are by far more sensitive to rising interest rates. Bank of Canada, of course, no different than the Fed and most other central banks, in that they had a big inflation issue to tackle. Obviously, here we are here. This is a chart that might be a chart of the US, might be a chart of Germany or Japan even. Inflation rose everywhere in the wake of the supply chain disruptions and labor market disruptions that the pandemic wrought. And so, of course, this was met with an aggressive rate hike cycle from the Bank of Canada. What this is telling us is that the sensitivity to higher rates is much greater in Canada than almost any major economy. Next one down is the UK right here. Its household debt to GDP is sub 80%. Then is the US, even lower. Then is Japan, even lower. And then is the European Union, lowest. Now, for Canada, it's well over 100%. Moreover, the average mortgage in Canada can only be fixed for 5 years at most. Compare that with the US, where mortgages tend to get fixed for 30 years. And that tells you how consumers become very sensitive to rate hike cycles. Not only do they have to pay out a lot more because they hold a lot more debt, and so higher rates mean more and more of their income is spent servicing that debt, but they also face the impact of that debt relatively faster than, say, the US, because you have a lot shorter of a lockup period for what is the biggest outlay credit-wise for most households, and that's the cost of housing itself, the mortgage. Secondly, you have a weakness with in consumer demand, as we see here, coupled with a stingy government demand story that isn't making up the difference. Notice that from 2020, where we had a peak in the government's debt to GDP ratio, we've been stair-stepping lower year after year. And of course, what this is telling us is that there isn't public sector demand that's coming to back up the absence of private sector demand. The IMF estimates that for 2023, it's going to be 103%, 104% or so debt to GDP ratio for Canada. That's down from 118 at the peak in 2020. Compare that with the US. First of all, the peak and where we've come down to are both much higher. In the US, the peak was 126%, and we're now at 122. So we're actually higher now on our debt to GDP ratio, meaning there's more government spending supporting demand, than Canada was at its peak here. Moreover, we can see that there's been a far shallower decline here, and actually from 2022 to 23, there was a narrow increase. So there's a lot more demand generation happening from the public side of the ledger as compared to Canada as well. So how does this impact where we go next? Well, there's two ways that this divergence resolves. Needless to say, Canada and the U.S. economy are still tied at the hip, even though we're getting this divergence. Something like 500,000 people go across the border every single day. We get much more commerce happening between individual Canadian provinces and the U.S. than we do between those provinces as they transact with each other. In fact, until very recently, it was easier to do business for a Canadian province with the US than it was with another Canadian province. So the relationship continues to hold. But the question, of course, is which way this divergence will correct and what the Bank of Canada has to say about it. And there, we are looking first and foremost at the Canadian dollar, which might distill for us, after this Bank of Canada announcement, what to make of the signal for the US economy and therefore for the US markets. We have the Canadian dollar here sitting on the bottom of a range that's held now for the better part of 2 years. This is late 2022 here. We can see right around 71.56, 72.27 on 6C futures. That's the bottom of this range, and we're sort of settling here. If the Bank of Canada, which is also going to have an updated set of forecasts alongside its announcement and an updated monetary policy report, if it is going to be relatively optimistic about where growth goes next, well, then the degree of dovish intent that's already baked in, 75 basis points over 2 meetings is nothing to sneeze at, then you might see the Canadian dollar bounce because the central bank was not more dovish. In fact, it is already very dovish, and that's a high bar to clear. That optimism might come from a slightly better view on growth going forward, and since there isn't much happening domestically, probably not going to get a big fiscal outlay spree here as Prime Minister Justin Trudeau slides in the polls and has to call an election within a year, and judging by the way the polls look now, looks likely to lose it. But in any case, that's a year away perhaps, and does not put us into a position where a big fiscal outlay is more immediately forthcoming. On the domestic demand side of things, we're probably not looking at something that's going to meaningfully change either, because a lot of the issues there continue to be structural. Higher rates in particular are still filtering as mortgages adjust at clips of between 1 and 5 years, which is sort of the set of available maturities range for mortgages in Australia. It can be 1 year, 3 year, 2 year, 5 year, but 5 years the top. So that continues to hamstring consumers. So we have a situation then where if there's a more positive view on Canadian growth, it's coming from external demand. And there is something to be said about this story. If we look at the spread between core services and core goods in that PCE inflation data that we just saw right here, so essentially the spread between this and this, then we can see that it is now at the highest in almost 2 decades. And a more normal reading would be somewhere closer to down here, which suggests that there is perhaps a rebalancing of spending patterns, where once we get through the COVID knock-on effects, we get to a more familiar relationship between how much people spend on goods versus services. This readjusts, and that, of course, portends a pickup in U.S. goods demand, which would again help Canadian exporters and give the economy a bit of a lift, with perhaps knock-on effects to services because the money that those exporters make then gets spent domestically, and there's a bit of a virtuous cycle to be had. So maybe if there is a positive story here from the Bank of Canada going forward, what that implies is that Canada will recouple toward U.S. resilience, and we're going to have joint North American prosperity on the horizon once again. That would be consistent with a higher Canadian dollar, and the higher Canadian dollar would tell us it would be something of a tipping of the hat in that direction. That's if we bounce from these levels. That's not the only scenario. The other one is that Canada is a cautionary tale. If we look at this chart from The Economist, we see that the current rate hike cycle in the US is unique amid the other tightening cycles we've seen going all the way back to the dawn of modern finance in the early 70s when the US took the dollar off the gold standard. In every other tightening cycle before this one, companies' outlays on interest costs have increased. That's not surprising. As you get higher rates, that's this axis, companies should pay more for debt. That's the idea of raising rates. That's why you raise rates, to increase the cost burden from credit, to cool economic activity, and thereby curtail inflation. That is not what's happening in this cycle. We've had all of this change in rate hikes. Meanwhile, the outlay on credit by companies has actually declined. It's moved below zero. It's actually falling. And that's because companies hoarded cash during the pandemic. First of all, there was nothing to spend on, or at least much less to spend on because everything was closed. And second of all, interest rates were cheaper than cheap, and companies hoarded cash. That's why their outlays on interest payments have not followed other tightening cycles. Now, the rollover on these loans is typically 3 to 5 years. Going into next year, 2025 would be 5 years from the start of the pandemic. So we should start to see redemptions and rollovers of those loans. And of course, the Fed would need to cut by an astronomical amount in order for that not to be an important rise in borrowing costs on U.S. corporates. And of course, we see in Canada's example what onerous borrowing costs do to an economy. So perhaps in the U.S., the sensitivity is delayed, and Canada is a story of what happens but hasn't happened just yet. And it's the U.S. that corrects in Canada's direction toward a more anemic response, which might actually be a story about the Canadian dollar moving lower, because that would be, first of all, supportive of the U.S. dollar in the near term, in that it would be a darker story from the Bank of Canada, and so more scope for rate cuts there than in the U.S. near term, but also a reason for stock markets to get a little bit worried, perhaps downwind, about what the U.S. economy may face in the quarters ahead. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may head from there. I'm on with Chris for Futures Power Hour on Mondays and Fridays, on with Victor Jones for The Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.